What's going on, investors? AK from Fallible here. And just recently, we saw the Dow Jones Industrial Average. That's too many D's. We saw the Dow Jones Industrial Average close below its 200-day moving average for the first time since 2016. So of course everybody is talking about it. They're panicking a little bit. Should we sell? Is it a bear market? And then of course the bloggers are all talking about it too, because that's what people want to know about. And really it's just a huge echo chamber, which I figured I'd join because, I love echo chambers. The only chambers I love more than echo chambers are chambers of secrets. Am I right, Mr. Potter? But in this video, we're going to talk about the correct way to look at the 200-day moving average and how you can use it to improve your trading strategy. Okay, so the 200-day moving average, if you don't know, on any chart is just the average of the prices of the asset over the last 200 days. So it's a little line on the chart that cuts out the noise and smooths out what's going on with the trend. And what a lot of investors do is use this moving average as a determinant of how the market is doing. So the way they look at it is if the current price of whatever asset you're tracking is above its 200-day moving average, then you're in good shape. But if it's breaking below the 200-day moving average, then you're in for some trouble. Then you get all those worries about a bear market and selling and all that fun stuff. So most of the time, the 200-day moving average acts like a support for prices, kind of like you see here. So usually if the market is healthy, then price will bounce off that 200-day moving average and keep heading higher, which is basically what we saw with the Dow. But if it breaks below that line, then there might be some issues. Now, like I said, as soon as price breaks below that 200 line, people start panicking. Like, oh no, it's all over. But no, you shouldn't be doing that. You shouldn't be selling all your positions just because price broke below. If you're tracking a market like the S&P 500 or the Dow Jones, and you're using the 200-day as a signal of whether you should be in or out of the market, you are gonna get chopped up a lot. Because really, minor breaks of these moving averages happen all the time. And if you're reacting off of every little break, you're gonna be caught up in noise. And you're gonna be over trading and you're gonna put yourself through a lot of pain. Really, what you wanna use moving averages like the 200-day for is to establish a trend. The slope of that line gives you a good idea of how the market is doing. So if the 200-day moving average is moving nicely up, then you got a healthy market. If it's starting to flatten out, then you've likely been seeing some consolidation in the market and you need to keep an eye on it. Now, if the 200-day is turning and moving lower, then at that point, yeah, you might be in a bear market and you should probably stay out. But the point is to use it to establish the trend, not to react off of every little break that happens above or below it. And that's especially true for the kind of markets that we're in now, where wherever it drops, you see a massive rally back higher. Why? Because everybody's just buying the dip. So if you're gonna react off of every break, you're gonna be shaken out real quick and then miss the massive rally higher. Now, what you can do is use the 200-day moving average as a signal for one part of your strategy. So for example, if you have an equity trading strategy, well, it makes sense to track the broader market with something like a 200-day moving average because 50% of a stock's move comes from the broader market anyway. 30% comes from the sector and only 20% comes from the stock itself. So you need to track the overall market because it is very rare for a stock to keep heading higher when the rest of the market is heading lower. You don't want to be investing against that tide. So in your strategy, the 200-day moving average on the index can be a sort of risk control. Now, I'm not saying sell all your positions as soon as the index breaks below it. I told you why that's bad because of the chop. But maybe when the broader index of whatever you're trading is below that moving average, you don't establish any new positions. Now, you're not selling everything, but you're not exactly buying anything new either. You're holding, because this could be a signal that the market is turning, or it could just be noise. You don't want to be too reactive because you got to wait and see. Now, there are successful rotational momentum strategies that I've seen that do this exact thing. What you're basically doing with the momentum strategy is taking all the stocks in an index and ranking them from strongest trending to least trending. And then you invest your money in the top stocks. And as time goes on, you'll see their rankings change and you go ahead and change your positions with those rankings. So what these strategies do is if the broader index is underneath its 200-day moving average, they don't establish any new positions. So as far as sell criteria goes in these strategies, it's all based on the individual stock. So if this stock breaks this level or falls out of this ranking, you get out of it. So they let the individual stock tell them when to get out, but then when they're looking at getting into a new stock, they make sure that the broader index is above the 200-day moving average. That way they know they're buying with the trend and not against it. Because like I said, you are not going to make good returns in individual stocks when the entire equity index is trending lower. That just doesn't make sense. So you can do something similar in your own strategy. Just use that 200-day moving average to tell you what the general market is doing, whether you should buy in or just stay stay out. But again, just don't be reactive off of every little break. And speaking of not being reactive, you gotta remember that different breaks mean different things. So if you see an intraday break below any moving average or support level, it's usually just noise. But if you actually see an end of day close below it, that's more of a signal, because the close is always more important than what's happening intraday. And an even better signal is when you look for a weekly close below a support level, because a weekly close is even less likely to be noise than compared to a daily close. So really, the farther you extend your timeline, the more likely a break will be a real signal and not just noise. And we keep talking about the 200-day moving average here because that's what everyone uses. But really, it could be the 201-day moving average, 205, 204.5, 203 3/4. It doesn't really matter. It is just an average that you're using to tell you about the trend and to help somewhat with the risk control. But don't get all caught up in what's the best moving average and overfitting a line to whatever system you're using, because you're gonna screw yourself over. Just look at the broad idea of what you're trying to do. And speaking of all these systems, I'm still working on the system for you guys. And I'm gonna be explaining more about it and teaching you the principles to create your own system in future videos. So if you wanna see those, make sure you subscribe and hit that bell for notifications when they come out. Now, if you have any questions about these moving averages, make sure you comment down below and I can answer them for you. And don't forget to subscribe so that way I can see you in the next video. Stay fallible out there. Bye.